level or profile, I guess, going forward when you look at these asset classes?
Well, we think that we're in a period of rate normalization, and we've written about this extensively, and I don't think that's out of consensus. However, I think we were a bit more aggressive than others. Earlier this year, we shifted a lot of our portfolios across the board from fixed income into equities. And we also raised a bit of cash at that time, which is similar to, say, shorter duration fixed income, and we have this barbell approach. So while we realize equities are still riskier than bonds, we think that over the next 4 to 5, 6 years, as rates normalize, equities should outperform bonds, and therefore we're willing to hold a bit more there.
We have seen a leadership change in the U.S. equity market over the last couple of months as interest rates also changed in terms of yields rising. Is that a trend that continues now, or will we continue to see shifts from sector to sector?
Well, I think that the market is going through a leadership change, and quite frankly, it's a positive development, because this is what you would expect if, in fact, the recent turmoil was essentially a mid-cycle correction, which is our view, that rates are normalizing in the middle of an economic recovery. This isn't the end of the recovery. Therefore, the stock market is essentially confirming that, meaning we're seeing a shift from interest rate sensitive stocks into what would be more cyclical, growth-oriented type sectors that are dependent on economic growth. So to me, I think the rotation is essentially confirming that it's a mid-cycle correction, not the end of the recovery.
Within fixed income, there are some areas you like over others, corporates, right?
Correct. Yeah, and I think that's also not really an out of consensus view, which is that the risk in the market is more on the rate side as opposed to the credit side. And if you believe that the economy is improving, which we're seeing confirmation of that now, then credit should do okay. Now, credit got a bit overpriced, and clearly so. We saw a correction in May and June as rates moved up. Credit spreads actually widened, which is unusual if the economy is improving. And part of that, I think, is a function of the fact that it got a little overpriced, and the other factor is liquidity. Liquidity in the fixed income markets is just not as good as it used to be prior to the financial crisis.